7 technology companies, Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla, now control $21.5 trillion in combined market value and represent 35% of the S&P 500. This concentration matches the highest level since 1932, just before the Great Depression wiped out 89% of stock market wealth. Analysts like Michael Burry and Jeremy Grantham are predicting potential losses ranging from $4 trillion to $20 trillion, while others argue this time is fundamentally different. What you're about to hear is the complete case for why the Magnificent Seven may be approaching a catastrophic collapse, the parallels to 1929 that should terrify every investor, and the specific vulnerabilities in artificial intelligence spending that could trigger the unraveling. Right now, the Magnificent Seven represent approximately 35% of the entire S&P 500, and Goldman Sachs research confirms that the top 10 S&P 500 stocks now command 38 to 40% of total market capitalization. This surpasses even the dot-com peak of 27%, and to find a comparable concentration level, you have to go back to the Great Depression. Individual valuations reveal an even more alarming picture. Nvidia leads the group with a market cap of $4.5 trillion and a trailing price-to-earnings ratio of 48.4, though its P/E ratio of 0.6 reflects expectations of continued hypergrowth that we'll examine more closely in a moment. Apple commands $4.1 trillion at a P/E of 36.3, which is historically elevated for a company whose 2025 earnings grew just 10% while its stock price drove P/E expansion of 27%. At $3.6 trillion, Microsoft trades at a P/E of 34.4, while Alphabet's $3.8 trillion. Valuation carries the group's second lowest P/E of 30.6. Tesla represents the extreme outlier, 300 times earnings. That valuation is driven entirely by speculation on robo-taxis and Optimus robots rather than current vehicle sales, and the company's Q3 2025 earnings fell 39.5% year over year due to price cuts and margin compression. Amazon, valued between $2.4 and $2.6 trillion, trades at a P/E of 32.8, while Meta rounds out the group at $1.7 trillion with a P/E of 30.4. Here's what matters about these numbers. The Magnificent Seven contribute 44.1% of S&P 500 earnings growth and 54% of price gains since the October 2022 lows, which means if these 7 companies stumble, the entire index stumbles with them. There is no diversification protecting investors who think they're safely invested in broad market index funds. Warren Buffett's Berkshire Hathaway delivered the most alarming institutional warning when it sold 605 million Apple shares through the first 3 quarters of 2024, slashing its stake by approximately 70%. Apple went from 50% of Berkshire's portfolio to roughly 21%, and while Buffett cited tax considerations, when the Oracle of Omaha dumped 70% of his largest holding while it's trading at price-to-earnings multiples well above his original purchase price, you should pay attention. Buffett isn't alone in heading for the exits. Over the past 2 years, Nvidia insiders have collectively sold $3.96 billion in stock, with CFO Colette Kress executing a $22.8 million sale in September 2025 at 4.2 times her typical volume. CEO Jensen Huang alone has offloaded $1.76 billion in the same period, and when the ETT census, people running these companies are selling at record rates, that tells you something. Hedge fund exposure to Magnificent Seven names fell from 21% in June 2024 to 15.5% by January 2025, representing a massive decrowding of formerly consensus positions. Morgan Stanley's Lisa Shallett noted in February 2025 that company insiders across the group are selling at the highest rate since 2021, and meanwhile 4 of 7 stocks traded below their 50-day moving averages, a bearish technical signal. Performance in 2025 confirms the leadership is narrowing. Only 2 Magnificent Seven stocks, Alphabet and Nvidia, beat the S&P 500's 17% return in 2025, and when the smart money is quietly exiting while performance fractures, history suggests the crowd should be nervous. Multiple valuation measures now exceed levels that preceded the 1929 crash, and The Shiller-Cape ratio stands at approximately 39.6 compared to 32.6 in September 1929, just before the crash. We are more expensive than the market that preceded the Great Depression. The Buffett indicator, which measures market cap to GDP, has reached an unprecedented 219 to 230%, and Warren Buffett himself warned in 2001 that anything over 120% suggests overvaluation. The historical median sits at just 80.4%, which means we are nearly 3 times the historical average. The structural similarities go beyond raw valuation numbers. In 1929, RCA, Radio Corporation of America, played the role today occupied by Nvidia, and this transformative technology company saw its stock appreciate 352 times from 1921 to 1929, while trading at a peak price-to-earnings ratio of 72 times. Radio equipment sales had exploded 1,400% between 1922 and 1929, and everyone believed radio would transform society. They were right about the technology, but catastrophically wrong about the valuations. RCA subsequently crashed 95% from its peak. Today, artificial intelligence infrastructure spending has surged from $155 billion in 2023 to a projected $320 to $380 billion in 2025, and the parallel is almost exact. A revolutionary technology driving massive investment and speculation, with valuations detached from current fundamentals. Margin debt presents another troubling parallel. FINRA reports margin debt reached $1.21 trillion in November 2025, a record high representing approximately 3.6% of GDP compared to 3% at the 1929 peak. The divergence between margin debt growth, which is up 45% year over year, and market gains has appeared only 3 times in history, before the 1929 crash, the March 2000 dot-com peak, and the 2008 financial crisis. What happened after 1929 should terrify you. The bear market unfolded over 34 months and ultimately erased 89.2% of the Dow Jones Industrial Average, and the market did not recover its 1929 high until November 1954, 25 years. An entire generation of investors never recovered their wealth. Deutsche Bank's Jim Reed has explicitly cautioned that the US stock market is rivaling 2019-29 in terms of being its most concentrated in history. Now we get to the core vulnerability that could trigger the collapse, and that's the artificial intelligence revenue gap. The Magnificent Seven are collectively spending between $320 billion and $380 billion on AI infrastructure in 2025, up 62% from 2023. Amazon leads with $100 to $125 billion in capital expenditure, followed by Microsoft at $80 to $94 billion, Alphabet at $75 to $93 billion, and Meta at $60 to $72 billion. And in Q1 2025 alone, Microsoft, Alphabet, Amazon, and Meta spent $72 billion in a single quarter. AI-related revenue dramatically lags this spending. Sequoia Capital partner David Kahn identified what he called the $600 billion question in June 2024, noting that AI companies need approximately $600 billion in annual revenue to justify current infrastructure investments. But actual AI-related revenue reaches only $100 to $125 billion, 5 to 6 times gap between investment and return. Specific examples demonstrate why this matters. MIT research from August 2025 found that 95% of generative AI pilot projects fail to deliver measurable returns despite $30 to $40 billion in aggregate investment. And Fortune estimates that Microsoft, Meta, Tesla, Amazon, and Google invested approximately $560 billion in AI infrastructure over 2 years, while generating just $35 billion in AI-related revenue combined. OpenAI, the poster child of the AI boom, projects cumulative losses of $44 billion between 2023 and 2028 and doesn't expect profitability until 2029. Meta's Reality Labs lost $4.4 billion in Q3 alone on just $470 million revenue, with 5-year losses approximating $50 billion. Goldman Sachs research head Jim Covello stated bluntly in June 2024, Despite its expensive price tag, the technology is nowhere near where it needs to be in order to be useful. Overbuilding things the world doesn't have use for or is not ready for typically ends badly. That quote should be carved in stone. Overbuilding things the world doesn't have use for typically ends badly, and that's the history of every technology bubble ever recorded. Michael Burry became famous for predicting the 2008 housing crisis, a bet that made him hundreds of millions of dollars and became the subject of the movie The Big Short. And in November 2025, Burry disclosed a $1.1 billion short position against AI stocks in his SEC filing, approximately $912 million in Palantir puts and $187 million in Nvidia puts. And his Palantir puts pay off if shares fall to around $50 from around $200, a 75% decline, while his Nvidia puts target around $110 from around $190, a 42% decline. Burry expects a 20 to 30% Magnificent Seven pullback by mid-2026. Jeremy Grantham is the co-founder of GMO and called both the dot-com bust and the 2008 crash, and in February 2025, he declared a super bubble, noting US stock valuations had surpassed peaks of 1929 and 2021. He predicted the market could easily go down by 50% and be well within its historical boundary. And on Nvidia specifically, Grantham compared the company to the guy selling the shovels at the peak of the gold rush, predicting it may lead the Mag 7 crash. David Rosenberg, who accurately predicted the 2008 recession, identified breadth measures as the worst since 1999, with just 7 megacaps accounting for 90% of market performance. Ruchir Sharma, the chair of Rockefeller International, confirmed in December 2025 that AI checks every box on his 4-part bubble checklist, predicting the bubble could burst in 2026 if interest rates rise. Goldman Sachs warned in September 2025 that a major AI investment slowdown could cut S&P 500 valuations by up to 20%, while a sharp correction could erase $30 to $40 trillion in Nasdaq market value. The IMF's Geeta Gopinath estimated an AI bubble burst matching dot-com severity could destroy $20+ trillion in American household wealth. These aren't random bloggers or perma-bears. These are some of the most respected analysts in finance with track records of calling major market tops, making specific, attributed predictions about the Magnificent Seven. The 2000 to 2002 dot-com collapse offers the most relevant modern precedent for what could happen, and the Nasdaq fell 78% from its March 2000 peak of 5,048 to its October 2002 trough of 1,114. More than $5 trillion in market value was destroyed, and the index did not recover its March 2000 high until April 2015, 15 years. April 2000 alone saw the Nasdaq lose 34.2% of its value, a breathtaking speed of collapse, and the week ending April 14, 2000 saw a 25% decline that surpassed even 1987's Black Monday. Individual stock declines tell the human story behind those numbers. Cisco Systems fell 90% from a market cap of $500 billion to $50 billion, and as of today, Cisco still trades below its 2000 peak. 25 years later, Amazon fell 92% at its trough before eventually recovering. Priceline fell 94%, and Pets.com and Webvan fell 100%. They went bankrupt. The Nifty 50 collapse of 1972 to 1974 provides an earlier parallel, and these were quality growth stocks trading at average price-to-earnings ratios of 42 times compared to today's Magnificent Seven averaging around 38 times forward PE. During that bear market, Polaroid fell 91%, Avon fell 86%, Xerox fell 71%, and McDonald's fell approximately 70%, and the Dow did not reclaim 1,000 for another decade. These weren't speculative penny stocks or fraud companies. These were America's best businesses trading at valuations that assumed perpetual growth, and when growth disappointed, the punishment was severe and lasting. Several identifiable catalysts could convert current risks into realized losses, and Federal Reserve policy reversal represents the primary risk. Economist Ruchir Sharma explicitly warned that rising interest rates are the signal that this is done now, and the the 1929 and 2000 crashes both followed Fed tightening cycles, with inflation remaining sticky above the Fed's 2% target for 5 consecutive years. Resumed rate increases cannot be ruled out. Earnings disappointments loom as Magnificent Seven growth decelerates from 40.4% in 2024 to a projected 18% in 2025, and Bank of America's Savita Subramanian warns of an air pocket where heavy AI capital expenditure continues but expected profits fail to materialize. Most 2025 price appreciation came from multiple expansion rather than earnings growth, and Alaric Securities notes this pattern has often preceded a correction. Circular AI financing has created interdependencies resembling the dot-com era's vendor financing schemes. Nvidia purchased $6.3 billion of CoreWeave's unsold data center capacity, while holding 7% of CoreWeave's shares and supplying its chips. And OpenAI's $300 billion deal with Oracle depends on both companies' continued ability to finance infrastructure neither can currently afford. NPR reported in November 2025, if we get to the point after spending hundreds of billions of dollars on data centers that we don't need a few years from now, then we're talking about another financial crisis. When the trigger comes, whether it's a Fed rate hike, a major earnings miss, or an AI company bankruptcy, the concentration of the Magnificent Seven means the selling will be forced and brutal. 35% of the S&P 500 trying to exit through the same narrow door at the same time. Fairness requires presenting the other side, and Dan Ives of Wedbush Securities argued in November 2025 that this is a 1996 moment, not a 1999 bubble moment, predicting tech stocks could rally up to 25% in 2026. He emphasized that less than 5% of US enterprises have implemented AI strategies, suggesting the monetization opportunity remains in early innings. The fundamental differences from .com are real. The Magnificent Seven collectively hold $600 billion in cash reserves, they maintain strong profit margins, and they generate actual earnings. This is not Pets.com or Webvan. These companies have real businesses generating real cash flow. Roundhill Investments calculates Magnificent Seven forward price-to-earnings ratio at 24.9 times with a 1.2 times relative premium to the S&P 500, levels not seen since the 2022 bear market bottom, and 5 of 7 stocks trade below their 5-year average forward PE. 54 of 56 analysts rate Microsoft as buy or strong buy with an average price target implying 29% upside, and Nvidia enjoys similar consensus with 60 of 64 analysts bullish. Morgan Stanley projects S&P 500. Earnings could reach $317 in 2026, representing 17% growth, with a bull case pushing the index toward 8,000. AI market projections supporting these valuations include Grandview Research's estimate of $1.81 trillion in AI revenue by 2030 and Youngtad's forecast of $4.8 trillion by 2033. And Morgan Stanley estimates AI could create $13 to $16 trillion in added value through productivity gains. If these projections are realized, current multiples may prove justified. Applying historical decline percentages to the current Magnificent Seven market cap of $21.5 trillion yields specific numbers for potential outcomes, and a correction similar to the 2022 bear market, a 20% decline, would destroy approximately $4.3 trillion. A pullback matching Michael Burry's estimate, 30%, would destroy approximately $6.5 trillion, while a major crash matching Jeremy Grantham's scenario, 50%, would destroy approximately $10.75 trillion. A bubble burst matching the dot-com style decline, 78%, would destroy approximately $16.8 trillion. $16.8 trillion in context. That's more than the entire GDP of China, nearly a year of US economic output, and the wealth of hundreds of millions of American families who own these stocks through retirement accounts and index funds. The weight of evidence suggests elevated risk. The Shiller KP exceeds 1929 levels, concentration matches, Great Depression peaks, margin debt has hit records, and AI investment dramatically outpaces monetization by 5 to 6 times. Credible analysts, including Michael Burry with his $1.1 billion short position, Jeremy Grantham with his 50%, Decline prediction and David Rosenberg noting the worst breadth since 1999 have made specific, attributed warnings. Timing remains the fatal flaw in bubble predictions. Alan Greenspan's 1996 irrational exuberance warning preceded an additional 93% market gain before the eventual crash, and the Magnificent Seven's fundamental superiority to dot-com-era companies, real profits, massive cash reserves, proven business models, provides genuine support that was absent in 2000. The resolution may come from AI's return on investment trajectory. If the technology generates the $600+ billion in annual revenue required to justify current investment within 2 to 3 years, valuations could prove reasonable, but if adoption disappoints, the $320+ billion being deployed annually becomes stranded capital. The precedents of RCA, Cisco, and the Nifty 50 demonstrate how severely markets punish unmet expectations. What we know is this: investors are holding positions in companies representing 35% of the S&P 500 at valuations exceeding any period except the 2000 dot-com peak. Whether that represents rational recognition of AI's transformative potential or the speculative orgy that British Chancellor Philip Snowden identified in 1929 markets will likely become clear only in retrospect, as it always does.